Hi Jay, wish you a very happy Pongal.
Hi Ramya, happy Pongal to you.
Thank you. So, in this Pongal season, I thought we can start the year with four very bullish strategies and pray for bountiful harvest in our stock portfolio this year. So, let's start with one of them, which is the vertical put spread, credit spread. What do you think?
Absolutely, Ramya, and what a nice timing to start with bullish strategies for this series, right? We celebrate bulls during the Pongal festival, and let's get started. So you wanted to start with the put credit spread, right?
Right. And I wanted to take a relatively smaller ticker symbol. So, how about we look at Intel, which has been doing quite well actually this year and probably has more potential.
Also, the timing is pretty good for Intel. The reason being, Intel is going to have earnings next week, and doing a put credit spread, which has a sell put at a higher strike and a buy put at a lower strike, is very apt right before earnings. The reason being, you will have very good premiums for all the option contracts, and you will probably uh, look at a fairly uh, good strike as well as the expiration. Do you have any expiration date in mind, Ramya?
Maybe 6 months out, let's do July of this year.
Okay, July
And
and
a strike close to wherever Intel is at now, so maybe 45.
5. Yeah, I think I read your mind. So yeah, so we will do a short put at 45. If we were to do just this alone, this means that you can either do it cash secured or using margins. And if it is cash secured, you will receive a credit of around $570, and you will end up taking the assignment if it hits. If it is like 45 minus 570, basically it's almost close to $40, you will end up taking the assignment should
Right.
you take the assignment
Okay.
instead of going just blind with cash secured put. If you want to protect yourself, then you add a buy leg, and then
Mm-hmm.
you go to the same expiration date, which makes it a vertical put credit spread, and you go for a uh, lower strike. Let's say take 30, then the put credit spreads width is almost close to 15, and as you can see, um, so this will cost you around $112,
Right.
1.1 to 100. So if you apply this together, and as you can see here, this has a maximum profit potential of $458, and the maximum risk is 1042. Maximum risk, assuming that this is the maximum you can lose from this
Mm-hmm. From the spread.
from the spread. And if you are willing to take the assignment, then you can just take the assignment, and if it goes down, you can just close the buy put alone. And if it rallies up, then obviously, this is a bullish credit spread. If it rallies up, you're going to see this go up. So let's say that Intel goes to $50 by April 17th. Like you can see, these two legs together
Mm-hmm.
will make a profit of $170. You've already
Right.
received 458. What it means is you will retain this $170 and return the rest alone back to
Right.
your platform or brokerage. So if it goes to 50 itself, it is, I mean, forget about even 50. If it even stays at 47 by June, you are still making a good profit, $265. Meaning
Right.
that what this actually means is if it rallies up, or if it stays very close to your strike, or even if it goes slightly above, this is kind of a sure shot win for you, where you want to make profit out of this. And if it goes down, then you will have to manage this individually, or you can just close it together
So,
for.
can we also simulate it, Jay, where it say goes down to say 35 or something?
Why not? So if it goes down by June, then you're technically losing around $503.
How
If
much is the
you want to
profit
get
that the buy put is making at that point?
sure,
So,
Ramya. So the sell put alone is at a loss of this much, and then the buy put is still at. I mean, this is showing because now there's a lot of implied volatility on
mhm.
Intel, and after earnings, this will get crushed. Ideally, this buy put should be gaining value if it goes down. If it is like 35, or let's say if it is 30. buy. See, as you can see, if it is going to 30, then this buy put has gained around $76. If it falls to, let us say, 20, you're actually making $888 out of this buy put. But I mean, that is assuming that you are willing to write the short put separately and willing to take the assignment. This is a protection for you because this is going down and you've entered this. Typically, people close put credit spreads together for
Okay.
50% max profit or 50% loss, and then you can roll it. And there are probably we will discuss that for a separate session and do one video on how to adjust if the direction that you have taken, which is now bullish, right, is not accurate in the sense you've assumed it's going to go bullish and then it has gone south. How you will adjust, we will probably cover that separately. But having said that, June 19th, you're going to be close to $351 profit on this, and your margin requirement is 45 minus 30, which is like 15 is the wet, 15 into 100, 1,500. And since you have received, it's like $1,042. Your max risk is going to be the margin need for entering this as a spread.
All right. Sounds good, Jay. I think that covers the vertical put credit spread, and we'll do the next series in a short while.
Absolutely, Ramya. Thank you.